So the purpose of this session is really to give each speaker 7 minutes to tell us what is hot and what's not in FinTech. And then we will open up to Q&A, so please have your Slido questions ready as and when. I will hand over to Gilles to kick us off.
Thank you, Ruth. Well, thank you, Ruth, and thank you, organizers, for giving us this opportunity. Good morning, everyone. Welcome to our third day of Finovate. So the topic today is global FinTech, what's hot and what's not. And I'm Gilles Bareisis, working for a company called CELENT. We are an industry research firm focused purely on financial services. So when I was preparing for this, I was thinking, there's so many things that I could talk about, which I know have already been addressed and will be addressed later on, from PSD2 and open banking to authentication and identity and blockchain and cryptocurrencies. But today I'd like to focus instead on just one topic, which is payments and Internet of Things. Now, Internet of Things is clearly going to have a transformative effect on entire industries like manufacturing, insurance, healthcare. But I think it's going to have a fundamental impact on banking and payments as well. Because as devices and entire platforms, such as cars, connect to the internet, they become conduits for commerce. And commerce transactions will change fundamentally, and therefore will require different payments capabilities. So in this very brief time today, what I'd like to do is introduce you our framework, the way we think about Internet of Things, that talks about 3 large stages of IoT evolution over a 10+ year time horizon, introduces 5 types of IoT devices, and 10 challenges that the industry needs to address. So to start with, what we already have today is what I call order facilitators. You can have a wearable, a ring, or a piece of jewelry that you can pay with. And you have also objects with user interface, whether it's a screen on your smart TV or a fridge or Amazon Dash button or Amazon Alexa through which you can already order. That in itself poses immediately a set of questions. Where should your payment credentials be located? If they are inside the device, how do you provision them securely, considering how many different types of chips and manufacturers you're going to have to deal with? Once they're there, how do you ensure the security ongoing for those credentials? And if they are in the cloud, again, that presents its own set of challenges. And authentication, what's feasible and what's necessary when we're talking about IoT? If it's a shared car, for example, once I get in, how does the car know what kind of credentials to use? And if it's a simple ring on my finger, what kind of authentication should I be expecting to use? But that's not that particularly interesting. I think where it gets more interesting is, and over the next 3 to 5 years, I expect this to come to sort of mass level, is what I call commerce orchestrators. And this is devices that can either prepare and execute transactions with users' approval or even sort of starting to act independently within specified parameters. And I think the difference between two is going to be less technological but more psychological. I think it's going to take us as users some time before we can start really trusting the devices and allowing them to transact without our authorization. I think one of the overused examples of IoT is a fridge ordering milk when I'm running out of that. Personally, I don't necessarily want that to happen. But I wouldn't mind milk alerting me that I'm running low on it, and then so actually adding milk to my shopping list, which I can review, approve, and place an order with. Similarly, with the car, again, I fully imagine that there will be a situation when the car will alert me that I'm running low on fuel, suggest, based on my previous preferences, which petrol station perhaps to go to, and when I get there, actually communicate with the pump to organize the transaction and actually even pay for it without me doing anything. I might have to click an approve button on that dashboard. Again, one of the things we're going to have to resolve is very clear liability framework, decision audit trail. How do I know that the device was acting in the way it was supposed to act? And once I start saying, well, actually, I didn't mean that, it was my device, how do I resolve those disputes? But it's actually going to be less about payments and more about orchestrating that transaction. So what sort of AI is going to be required? Where that AI is going to reside? How these devices will be communicating with each other. The example I gave between the car and the gas pumps, there are already proofs of concepts that are available today that actually exist. The car's talking to the pump, but try to scale that up across the entire industry, and the challenge becomes quite enormous. And then optimizing delivery of physical goods. Again, back to the example of milk. I don't want my fridge to order just a bottle of milk and have it delivered, and where I pay £5 for delivery of that bottle, and it sits outside in the sun while I'm away. Right? So how do we manage that? And then the final stage is what I call kind of the semi-autonomous economic agents, which is basically devices that can start acting independently to optimize their owners and their clients' objectives. And probably the best example I can think of that is a self-driving car that comes to take me to the airport, picks me up, decides on the best route. On the way there, if it gets stuck in traffic, starts negotiating with other cars and making small payments for them to move out of the way. I mean, it sounds like a fantastic story today, but I think with the right kind of infrastructure, this may and probably will happen. It will probably take 10+ years, of course, for that to really happen. But again, the proof of concepts of that already exists today. So what does that mean? Well, it means that it's probably we're going to have devices with payment accounts. So as banks, are we going to be issuing those payment accounts to the devices, to robots, to cars? More likely, it's probably going to be to the corporate companies that will manage the fleet of those. So that's why I'm calling them semi-autonomous rather than fully autonomous. And then how we're going to handle micropayments and the transaction volume that's going to come with this. Again, that's something that probably we're going to have a careful think about whether the existing infrastructure is going to be able to support that. And as you notice, all these industries stack up. It's not that authentication doesn't become less important when we move to that third phase. It will continue to matter, of course. The AI and the orchestration will continue to matter. So obviously, there's going to be probably no single company that can address all of these various challenges, so the partnerships will be absolutely essential. And it's something that we already see today, and the big theme of Finovate is about FinTech partnering with banks and other providers. So IoT is going to be no different. That's it. That's me.
Perfect. Thank you very much. So I think we'll take Slido questions at the end of all the presentations. Next one up is Oliwia from FORRESTER Research.
Great, thank you very much for having me here. I've been coming to Finovate for about 4 years now, but this is my first time on this side of all the tables, so it's quite an interesting look and certainly very different. What I wanted to start with today is a bit of an anecdote, or maybe like a riddle. Does anyone know what connects these 4 items on the screen? They are all sort of failures. To clarify, these are all objects that you can find at the Museum of Failure. So we've got Nokia Engage, Crystal Pepsi, Trump the board game, and Google Glass, and they're all at the Museum of Failure. The Museum of Failure has ironically actually been a resounding success. It started off in Sweden, and I hear is opening another branch in Hollywood. What these things illustrate, I think, is the difficulty of innovation. It's very difficult. Even if you're a top brand that is reaching, let's say, presidential heights, you can still fail. So for all of these brands, perhaps they should have consulted Forrester first. For over 30 years, we've been charting emerging technologies and analyzing the impact they will have on different industries. So most recently, systems of engagement, systems of insight, and systems of support. And of course, not all of these technologies will be equally disrupting, and certainly not tomorrow. But what I want to do today is discuss a little bit which ones of these will have the greatest impact in financial services and why. And first, a small digression before we get there. I do believe that it's not about a single technology, it's about the blend and how you mix them. Because magic happens when you combine things. Some time ago now, I went on my honeymoon to Japan, and I think the Japanese are really masters at blending things, from the Japanese garden to a well-composed bento box. So I've learned a few tricks, and one of them is what happens when you connect or bring together seaweed, an orange, and soy sauce. Any guesses out there? Probably not. Well, according to researchers from Kyushu University, you get caviar. So this is poor man's caviar, basically combining these three things. It doesn't maybe look as appetizing here, but it's only 9 o'clock in the morning. But do try it at the weekend and let me know if it works. Magic happens when you combine things. So taking me back to technology and how we can combine things to actually address some of the pressing problems for customers and businesses out there. I think we're at the time when a number of technologies are ripe enough to test and combine to address some of these problems. Take, for example, data coming out of open banking, which you access with customer consent. And if you apply machine learning onto it to spot patterns and trends, and you can generate real-time insights, which you deliver in extremely personalized, engaging way, then what you get to is digital financial coaching. We've had previous generations of personal financial management because obviously the lack of scalable, affordable financial advice for the masses is a big problem. But previous generations of personal financial management is a bit like that Nokia Engage picture compared to an iPhone. We can do a lot better now. Another example is perhaps if you combine data coming from connected devices, you apply analytics onto it to understand what's happening. You deliver insight, again, in a very sort of actionable, real-time way. What you can do with this now is actually customer outcome orchestration. And what I mean by that, it's not about pushing products to people, but about focusing on what they're trying to achieve and being able to surface digital applications, pieces of functionality, sometimes from third parties, entire digital experiences to the customer at their moment of need. So customer outcome orchestration is about focusing on delivering what customers want as opposed to pushing products out them. And another example that I wanted to mention maybe from the world of insurance, because even though this is a FinTech conference, I think there are many of you out there from InsurTech. I think when we combine connected devices with Internet of Things, software and solutions, analytics, insight platforms that basically bring together this data fabric, different systems together with the ability to analyze the data and actually generate some actions that are very useful for us. We, again, mix this in with some machine learning and automate some of the insight. We get to risk monitoring as a service. For a while now, we've been talking to insurance companies and telling them that they need to move away from just compensating people or companies after an event to a more proactive sort of risk mitigation and risk prevention services. And this is now happening, and you can finally do it, and you can imagine basically protecting commercial property in real time, or even intangible assets like digital identity in real time. So these are just 3 examples: digital financial coaching, customer outcome orchestration, risk monitoring as a service that are now all possible when you combine these technologies that are fairly mature or maturing in the next couple of years. The one element that I haven't mentioned, and that is key to the success of all of these different innovations, is another one, because with all of these things, you basically need 3 things to make them a success. One of them is desirability. Will this fix some existing customer problem or perhaps make a business impact, enable you to address another customer segment, perhaps tackle new markets? So do we actually want this? The second one is feasibility. Is the technology mature enough? Are you perhaps too early? Maybe it's 2 to 3 years away. Do you have the skills to adopt it? Will it integrate with what you have in-house? So is this actually feasible? And lastly, and perhaps the most important bit, is viability. And that's the one that I think many people forget. It's about the fact that you have the technology, but can it be scaled at the right price point? And the ecosystem maturity that goes with it, will the customers, businesses, and regulators embrace it? So this is the question that hopefully we'll debate today. Thank you very much.
Excellent. Thank you, Oliwia. Great. Well, next one up, Michelle from EUROMONITOR International.
Good morning, everyone. EUROMONITOR International, if you're not familiar with us, we're a global provider of strategic market intelligence, which means we have trends, market sizes, and forecasts to help, or we do all that to help companies make long-term business decisions. I manage our digital consumer research, and for this presentation, I'm focusing more on the consumer payments aspect of our research. So when I was thinking about what would be the top trend that I wanted to talk about today, we only have 7 minutes up here. We just finished our work on top 5 digital consumer trends. So I decided to just focus on one, which I think is around the idea of the Internet of Things. I think that could be the most impactful trend we're seeing. So we had computers obviously come into the homes back in the 1990s. We had mobile devices come into play about 10 years ago and teach consumers this idea about always being on. Now, always on is this new normal for consumers. This data I'm showing you here comes from our Global Consumer Trends Survey and just shows you from a survey perspective what consumers say they own. So you can see the smartphone is the most popular device, with other devices like smart appliance, smart watches starting to gain penetration. Now that we have more and more devices, whether it's consumers having a couple wearables, smartphone, computer, maybe fridges, smart fridges coming into play, we're starting to move towards this idea of ubiquitous connectivity. And we see the International Telecommunications Union, they define the Internet of Things as the concept of physical devices incorporating software, sensors, and network connectivity to enable those devices to collect data. So ultimately, it's about that interaction, a smart interaction, intelligent interaction between humans and things to create a new value proposition. As more devices are becoming connected, it could obviously impact commerce. Right now, we're seeing a lot more of the applications more industrial in nature. Maybe they remove friction from a process. Maybe they ease life in another way. But in terms of commerce, we are starting to see them trickle into that type of space and into payments as a result of that. So this is some data from our Global Consumer Trends Survey looking at commerce transactions done on a smartphone. Obviously, like I said, that's the most popular device. And what we see is, in terms of popularity, consumers use the device most frequently for buying a good or service. If you look at pure frequency, what they do on a daily basis with that smartphone, then reading reviews and comparing prices while in store are your most popular, with about 10% of the global population doing so. And our survey is based on internet-connected consumers, so these would always be a certain subset of the population. Now we're going to look at some of the ways that the Internet of Things could impact commerce. So the first is this idea of improved fulfillment logistics. So this idea of item-level censoring. That means that brands and retailers could track a product through the supply chain until the moment it ends up in the consumer's or on the consumer's doorstep. You have automatic replenishment. So this is moving towards that idea of being able to automate the purchase. So currently today we're in a scenario where companies like an Amazon could track your purchase history and then trigger a reminder to you to order something. But now with this notion of products being able to track, of being able to put technology in, let's say, a consumer appliance, you can monitor consumption instead, which is clearly a more accurate measure of when you would need a product. So we're not too far off from this notion of the device, the smart appliance, being able to alert you that you need to order something or being able to do it on its own. And then you also shift in this idea of goods as a service. So as you have this technology embedded into these appliances, it means that, for example, with something like consumer appliances, those kind of manufacturers, they could layer on more services. So now their devices are more technology enabled. It means they could do things like remote monitoring, predictive analytics, and that helps with their relationship, because today you may only talk to Whirlpool every 15 years when you buy a new appliance. This could be a way of having an ongoing relationship. So in the future, more commerce will be driven by machines. We're starting to see consumption on the cusp of moving from this idea of being active to more passive in nature. And this is challenging for brands, challenging for any number of brands, whether it's CPG brands, retailers, or payment brands themselves, because when the purchase is automated, it means the consumer is making less choices to make that purchase. That means less opportunities to interact with your brand, less opportunities for you to influence that purchase in some way. So it becomes more and more important that you are immediately connected into that line of purchasing. And I wanted to talk briefly about what's not hot. I know that was part of the topic for the session. So I'm going to just talk about 3 quick things. So this idea of uncontrolled data gathering, I think that's definitely something that's falling out of favor. I know you folks in Europe would be very well familiarized with the privacy regulation coming down the pipeline that will take effect in May. So that is going to start to shift this idea of ownership of data from being about a company controlling it to a consumer having more control. It could have global implications because if you're a US-based company operating in Europe, even if you only have 1% of your revenues here, it does mean that you have to take this into account or else put 4% of your revenues at risk. So I think that has some far-reaching implications. And then the second one is the idea of standalone apps. We're seeing consumers download less apps and also use them less frequently. And you're also seeing out of the East this idea of super apps, multi-functionality being intertwined. And then the last is this idea of marketing to the masses. So society is shifting from this idea of being about the masses to a story of one, and this is where AI comes into play.
Excellent, Oliwia.
Thank you.
Michelle, thank you very much. Okay, next one up, we've got Kieran from OVUM.
Thank you. Right, well, good morning, everyone. It's great to be here, and a quick note of thanks to the organisers of the events for inviting me to be part of this great panel this morning. My name is Kieran Hines. I'm Head of Industries and Financial Services Technology at OVUM, and we're a technology analyst research house specialising in tech, media and telecoms based here in London. And so when I was thinking about this topic, again, it's FinTech, what's hot, what's not. It is a very, very broad brief, which obviously is usually quite a good thing to analysts. Lots and lots of things to talk about, but I'm already feeling the pressure of the gong, so I had to streamline my thinking down to just a couple of areas. I'm going to cheat a bit, though, and so rather than talking about specific technologies, what I want to talk about first is open banking, which, I mean, this obviously felt like a reasonably appropriate visual metaphor for open banking. And now, the reason, my rationale for this is quite a simple one, because if we're thinking about what is going to be one of the biggest drivers of what is hot and what is not in the FinTech space over the next 5-10 years, then open banking initiatives very much top of that list. Where was I? There we are. Okay. Now, I'd like to share a bit of our research for you on this. And I think from certainly the conversations we're having in the marketplace and the work that we're doing, there's a growing sense that the concepts of open banking genuinely is becoming viewed within big parts of the industry as opening the bank. And while certainly some organizations are approaching this as a compliance exercise, particularly where these are driven by regulatory initiatives, such as obviously at European level, and we have a similar approach in the UK, obviously. There is a very real sense that this is being viewed more and more as a strategic imperative. And so just to share some research, towards the end of last year, we surveyed about 500 retail banks around a range of issues, one of them, of course, being open banking. And just to give you a sense of the progression towards the evolution of new thinking around this topic, 64% of banks, this is globally, hold the view that open APIs are an important part of their strategy. And why? About the same proportion, so again, almost 2 in 3 believe that open APIs will lead to better products and services for their customers. And both of these numbers are up about sort of 10 points on last year, so we can really see progression in these viewpoints. And what does this mean? I think that there are really several layers in which open banking will come to reshape the dynamics of the value chain in the banking space. I mean, the first, as we've seen over the past couple of days, are some great examples of new and innovative propositions that can be based around data aggregation. Obviously aggregation in its own sake, but of course also applying data analytics and potentially artificial intelligence on top of that to personalize and deliver recommended actions, those kind of things. So some huge opportunities there. I think this will, of course, go a lot further, and there are some fantastic use cases already out there about how banks should be thinking about enabling their clients to see or surface banking services to the areas where their customers are active, in particular the SME and the corporate space, for example. There are other dimensions here too, and I think one of the most interesting, and thinking from the point of view of the FinTech space and catalyzing innovation, as a large bank, of course, once you've gone through the complexity and pain of exposing APIs out there, that becomes a very, very fantastic platform from which a bank can look to partner very quickly with third parties of all sizes and launch new innovative solutions in a far more agile and responsive way than they can at the moment. So that's just one example, I think, of the way in which open banking will change the pace and direction of travel in this space. And I think the other as well, of course, again, for a large institution, once you've created developer portals and sandbox environments, those aren't just for, or shouldn't just be for, third parties to play with. Your own internal development team and development partners should be working with those resources again to drive innovation, new services and propositions for customers. And of course, with that, there is a genuine sense that there will be winners and losers here, and those banks that are not proactive and do see this as a compliance-led stand to lose out in the medium to long term. And just to round out this slide, so 56% of our panel also hold the view that open APIs are a direct threat to incumbent banks. And that threat and that risk comes, I believe, from not taking advantage of the opportunities that this presents to organizations. The second thing, and again, an appropriate visual metaphor for a man running out of time, is real-time payments. And so I think, again, one of those topics which, of its own right, again, is not, strictly speaking, a technology, but much like open banking, will provide a foundation for, again, a whole new wave of innovative services and propositions. A lot of activity looking at the overlay services space. Of course, I think there'll be huge amounts of competition and innovation in those areas, and we're already seeing in the UK, of course, and the work of the new payments architecture, some fantastic ideas about different ways in which new services can be run across real-time rails. I think one of the most interesting aspects on top of that is what happens when you put together sort of PSD2 or open APIs and real-time payments. We did some work last year to look at the potential impact of those two factors on the e-commerce sector. And I am running out of time. This is going to be a bit more brief than I would have hoped. But our projection, based on a number of factors, but particularly the economics of this and the ability to layer in new services, is that between now and 2027, we expect something like 30% of European e-commerce transaction values to go across real-time payment rails. And with that, I am out of time.
Excellent. Thank you, Kieran. Now, finally, Ron, and then we'll move to an exciting set of Q&As that is building up here. Okay.
Hello, everyone. I'm Ron van Wezel. I work for AITE Group. I'm covering retail banking and payments in Europe, and very happy to be here. What I wanted to cover with you today is the trend that we see that banks become tech firms. And that's not a new notion. Already in 2014, Michael Corbett, CEO of Citibank, said that he considered Citibank to be a tech firm with a banking license. Now, fast forward 4 years. Those of you who have attended the demo sessions of the past 2 days, you see so many innovations that are presented by new companies. And I noticed there were only 3 banks among all those presenters, and 2 of those worked together with another firm. So that's probably not a real good proof of the KPI that we thought that banks become tech firms. Still, banks have no choice. They're facing customers that are coming with totally new sets of expectations. Things have to come over the mobile. It has to be in real time. It has to be on demand, anytime and anywhere. Banks are facing new players. They're facing you. So these are tech firms that go in the other way and have become banks or have become near banks and actually encroaching on the value chain of banks and taking away some of the juicy parts. And then banks traditionally were the custodians of clients' data. They were actually, and the great picture that was shown by Kieran, the vault that is now going to be opened because regulators say it's the customer that is owning their data. And you see that back in the PSD2, you see that in the General Data Protection Regulation here in Europe. And that opened a can of worms as well in the security side. So this new API is a new channel that can be attacked in new ways. So how to manage all that? Because eventually, even when the third party gets access to your client data, if something goes wrong, the bank is going to be liable. And that's what the regulators want to keep in place. Well, banks at the same time are struggling with a huge legacy. And that's not only technology legacy, it's also, or maybe even the more priority, is organizational legacy. So operating models and processes that have been in place for decades, they have to be changed now, maybe turned around on its head. Come back to that later. Sales channels, so no longer a branch-based sales strategy, but really turning that into a digital experience over all your channels. Being able to provide the same experience of any channel customer chooses to use and have this great customer experience crossing your internal bank silos. It's a challenge as well. New distribution networks, other processes, and to be able to work no longer with structured data and EDI-type formats, but with unstructured data, big data, artificial intelligence, and piece all that together to provide that new bank. So what does it mean in terms of the digital transformation that we witnessing now with some banks? So not all banks are on this journey. I'll come back to that. But see some of the leading banks that seem to start to get it now. And each of those elements I'm going to address here are opportunities for you here in the audience to help these companies realize that journey. So first of all, customer centricity. So the idea that the customer is in charge. So you develop your processes outside in rather than inside out. So banks used to have this vertical approach where you produce and deliver everything yourself and you push your product onto the customer. Now you say, okay, start with the customer journey and then engineer that back into your internal processes. And you can't do that alone. You work together with companies that are better in certain aspects of the value chain. And I mean, people like you here in the audience. It means agile development. So banks used to have like the waterfall type of development method where we would have 2 releases per year as a bank. Now we have to deliver every couple of weeks because the change in demand is changing so quickly that you have to be able to deliver and be agile just as your FinTech competitors. And agile is great when you are working, say, for instance, on a mobile app, but agile development where you're replacing core systems is a completely different ballpark. That's really a challenge, and maybe it's something that is not completely spec'd out of how to do that. We saw yesterday some interesting presentations. People said, okay, we can do this with smart contracts, and used to have a blockchain approach to approach that problem. Work with a new technology stack. So all the things that IT people in the bank were used to will have to change. So we're going into REST APIs, we go to microservices, we go into blockchain, and bring that into real practice. That is a challenge as well for banks, and it tends to kind of an educational process to reach that state they have to be in. And last but not least, it's about culture. So we speak to some of the largest consumer brands in the world, and you would say everyone would like to work for those companies. But also they have difficulties of attracting the best developers. These people can choose where they want to work. So if you don't, as a bank, if you don't provide the right culture for these people, where these young people want to work in, so to show their creativity, then you're going to lose out. You'll not be able to attract the right talent, and then you got stuck before you even get started. And cultural change, it's not taking your tie off or wearing jeans and sneakers and growing a beard, right? It's really get it right from the top down. So the most successful companies that we see in the banking space that have realized this are where the CEO gets the message and starts thinking digital. That's why these journeys can become successful. So we're looking at the new banking paradigm, and we're really interested to see next year at Finovate if this is still going to be a FinTech conference or is maybe going to have similarities to a banking conference. Thank you very much.
Thank you, Ron. Right, so in good old technology, obviously my Slido system doesn't work, but from memory, I'll start with the most favorite question so far, which was, which technology or innovation that we see right now will land in the Museum of Failure? And happy if everyone wants to say something to this. Do you want to have a kickoff?
Well, so I think I spoke about IoT, and I think IoT actually is still a candidate to get there. I think the vision is attractive, but there are so many challenges to resolve, and I think the question is back to that psychological, is whether the consumers are going to relinquish that feeling of control and actually allow devices to start transacting on their behalf. I think we will to some extent, but I think there's still a lot of hurdles to overcome to make sure that it doesn't end up in that Museum of Failure.
Oliwia.
I might be controversial. I've seen so many Alexas on stage in the last couple of days, but I think some of these voice-controlled speakers will end up there because they are clunky, they don't necessarily deliver the value that we want. They might become something else. A lot of the things that we've seen on that slide that I showed became something else. It's not that the initial idea was completely discarded. It took a slightly different form. So I think conversational interfaces will take a different form than those speakers. Yeah. So we look at data to understand how currently consumers interact with these voice assistants, and it's not through dedicated speakers. So I think adoption will be a challenge here.
I'd say in the Internet of Things, I think there's going to be a lot of different players trying different things and probably forgetting the value proposition in it. So I think there's going to be a number of wearables that go by the wayside. I've heard some crazy ideas why you might want to wear a wearable. I'm not going to call people out, but I think some of those may in the Museum of Failure, is that what it's called?
So maybe we switch a little bit gears. Another key question was, how do you distinguish an actual trend from a gimmicky hype? Ooh. Do you want to take that?
That's your $1 million question, isn't it? I suppose, how do you separate, I mean, the trite answer is, of course, how do you separate hype from anything else is success, I suppose. And I think we see in the technology industry a huge amounts of hype attached to lots of different technologies. And it's usually once the hype dies out that things become interesting, certainly from my point of view. And so yeah, very difficult question to answer. I think what tends to really define what will make that difference is, of course, the degree to which these technologies address underlying customer issues, because it's only, of course, where you solve a problem that you can drive revenue, of course, on the back of that, and that determines your success.
Perfect. And maybe a question for Ron. Combination of two questions. What role will big techs play in financial services? And do banks have a future? Because it sounds like they're getting disintermediated. You addressed that they're changing their strategy, not all of them. but it's about customer centricity and all the other steps. But do you really think banks will be saved?
They will definitely not be safe, at least not all of them.
Yeah.
So banks are late in the process. So 2 years ago, we spoke to some clients about APIs, and basically had to spell out what API means. And well, of course, other companies in the like a Facebook, like a Google, won't exist without an API strategy. But banks have a couple of big assets. First of all, they have the customers, and the customers don't tend not to switch too often to other providers. And of course, they have the assets and the money to make things happen. So I'd say that banks that engage in the right way in the digital transformation eventually will come out as winners. They can integrate with fintechs, maybe even acquire some of the most successful fintechs to integrate that into their overall organization. But there will be a large group of banks that maybe do not have the resources, do not have the strategy in place to make the transition, and those will be at risk, I'd say.
Right.
So it will be a kind of a world of two speeds.
So the ability to be customer-centric and combine magical ingredients to end up with caviar or the answer for banking in the future is kind of the way to go. Right, let me thank this fantastic panel for a wonderful kickoff to this conference.